Welcome back, everybody, to another episode of Take Back Control Tuesday. Now, I can't tell you what the outcome is going to be for each and every one of you, but what I can tell you is for the next hour and 40 minutes, the time we're going to spend together, if you apply what you learn, this will change your financial future. If you're here, that means you're ready for change. And tonight, that's exactly what we're gonna deliver. I've got a special guest for you. His name's Jason Sipple. He is a master of what you're gonna learn. But what are you going to learn? Well, Jason is gonna teach you three things. He's gonna teach you how to take back control of your money by being your own bank. And then he's also gonna teach you how to build wealth through your own debts and expenses. That'll be the second thing you learn. And the third thing you'll learn, hence the cars, you're gonna learn how to get all the money back for every single car that you ever buy, drive, and own. And before you get into it, one last favor, just click that button right there, the subscribe button. It would do me a huge favor. And also, right above is a little bell. Smash that bell so that every time I put new content out, you'll be notified. So I don't want to waste any more time. It's time for Jason to really show you all about the infinite banking concepts. Let's roll.
Take back control.
Tuesday night.
Tuesday?
Who here, and give me show of hands in the chat, who here wants more money? Who here wants control of the money that you make? Who here wants more freedom? Think of William Wallace in Braveheart. Think of his face painted blue. What's that feel like? That freedom. Who wants to feel financially free? Like, what would that feel like? What would that do for your family, for your relationships, for yourself? And I'm going to let you in on a little known fact, a little known process today that the wealthiest families and visionaries like the Rockefellers, Walt Disney, and the Rothschilds, the Morgans, the Stanleys have been using for decades, for ages, to build and preserve their empires. And this strategy is simple, it's legal, and it's something that we all have access to. And it all starts with just changing one thing. It's start paying yourself first. Shockingly, we're groomed to give up control of our money. We're groomed to take on the risk, and we're giving up a big chunk of the money that we earn during our lifetimes to the banks, to the government, and to Wall Street, the bad guys. And you want to know how you can recapture and recycle all of this money, bringing it back into your family. And it all starts, again, with just changing one thing. Where does your money go first? So we're going to dive in today to the infinite banking process, where you can learn how you're going to take back control and make money on every car that you buy, drive, and own. We'll uncover how you can turn your debts into an asset. Yes, you heard me right. Your debts into an asset, and how the banks make a fortune, and why success leaves clues. Like Tony Robbins says, you have to see the clues and then apply them for yourself. And I thought this was unbelievable. Even to someone like me who used to work a 9-to-5 job, has built some pretty incredible things. But when I saw this is like Matrix style. You can't unsee it. And when you see how simple this concept is, you'll realize that there is a way, a path for financial freedom for you and your family. We're going to go through the real life examples today, show you what money really is and the real applications of how you can do this right now and put yourselves in a place where you can build, keep, and create more wealth. You may think there might be a little voice in your head saying, this is too good to be true. This is not attainable. But I promise you, just being here already puts you in a very rare group of people. So let's get started. Now, there's been a lot of high school graduations lately, a lot of college graduations. So I want you guys all to imagine yourselves that you're in a room with 100 18-year-olds. And I'm up on stage leading, and I'm asking them, I'm saying, hey, do you believe that you're going to be financially free or financially secure at retirement? Now, these 18-year-olds are going to be jumping up, jumping out of their seats. They're all going to be so hyped up and saying, yes, I'm going to be a millionaire, a billionaire. I'm going to be the next Steve Jobs or the next Elon, right? The next Mark Zuckerberg. I'm going to be the next billionaire. I'm going to be the first billionaire with a one-person company. Like, that's coming, folks, with AI. and they're going to be so excited. But then we're going to fast forward to retirement age, to 67 years old, which is made up anyhow. And we're going to find out that only 5 out of that 100 were actually financially free. How is that possible? This shocking statistic by the Social Security Administration shows us, here in America, the greatest country in the world, the richest country in the world, where we have so many opportunities, how is it possible that only 5 out of 100 of us are going to be financially free? Well, it's because something happens between the age 18 and 67. We get wore down. We get wore down by the propaganda that the banks are putting out there, right? To give up control of our money, to assume the risk, to take on all that risk in our family. And today we're going to interrupt that. Like Will Rogers famously said, the problem in America isn't what people don't know, it's what people think they know that just ain't so. What you've been taught about money might not actually be the truth. I'm here to show you what the truth really looks like. And I need you to keep an open mind, because in this webinar, I'm going to challenge the way you think. And as I said before we jumped in, I want you guys being interactive like you are right now in the chat. I want you asking yourself the questions and make notes. Don't take notes. Making notes means that you're going to write something down, an actionable item, and you're going to take that forward with you after this call. You're going to say, Jason, I'm going to get my debts and expenses in order. Jason, I'm going to really financially weigh in. What is that note that you're going to make for yourself today? So who am I? Why am I here with this passion that I bring for you? So I'm going to rewind. I'm going to go to kind of a darker place for myself, a darker time where I jumped into being an entrepreneur. And I was learning and really giving myself the skill sets. And I was in the back of a mastermind in Mahwah, New Jersey, back in 2020. And I had become one of the leaders in this group. And it was an amazing group. We were helping people really become the best versions of themselves. And we were doing this exercise, like I'd love for all of you to do, to see what that big vision was. What's it going to look like in 10 years, 3 years, a year, and 90 days? And just imagine, what's it feel like, look like, smell like? Can you see yourself with your family happy, with all the money that you would ever want, whether that's millions or billions, or maybe just, hundreds of thousands, whatever that number is for you. And I started crying. I was standing there and I couldn't see it. All I could see was 18-hour days, trading my time for money, building someone else's dream, doing what my parents taught me. Show up first, leave last, work hard, be humble, add value. And in that moment of tears and looking at my teammates who were just shocked, they're like, why is Sipple crying? Why is he upset? It was because I realized, and they could be tears of joy at this point, because at that moment, I realized I needed a financial philosophy. I realized I really didn't understand money. And I wasn't asking the most optimal question. I wasn't asking, what are the wealthiest families doing? I had built a $25 million recruitment division in 3.5 years in corporate America. And we scaled the company from 30 to 600 million. And it was that same reason I jumped into entrepreneurship, because I realized that there was more, that we were meant for more, that we're capable of more. I mean, we're made in the image of the divine. And so when I asked my mentor, who's a fiduciary with 40 wealth management offices, has been practicing this concept that I'm going to teach you, from learning from the master, from the guy who wrote the original book, which I'm not going to give it away yet. I'm going to do it on the next slide. But he handed me that book and it changed my life. And so now I'm here to share this information with you in hopes that you're going to find your path to financial freedom as well. So who talks about this? Who talks about this? Who are some of the people? Well, there's this one guy, he wrote something like Rich Dad, Poor Dad. And now he's someone that's talked about this in multiple books. One of the ones that you're maybe familiar with is in Second Chance, Robert Kiyosaki. Right. And then there's this other guy who changed my life, who actually led me to being an entrepreneur and changing everything that I'm creating for my family and for others in service, was the big guy, Tony Robbins. He talks about infinite banking in section 5.2 of Money Master the Game. And then you have the book my mentor handed me, which I read in one night, but don't be impressed because it's only 91 pages with giant font. It's this guy right here, Becoming Your Own Banker. I made sure I had it with me today, which you can go to the Nelson Nash Institute and get it there, or you can go to Amazon. But this book's a must read. And then we got, my partners, Brent Kessler, Chris Naugle, who wrote, it's basically in a modern day Becoming Your Own Banker, mapping out the millionaire mystery, which is what we're going to talk about today. We're going to map out how you go from where you're at today. And if you want, how you can map out all the way step by step to being a millionaire. And then you got the private money guide, because when you see what banks do, when you see how they create wealth out of thin air, we're going to show you how to do the same, but do it in a more stable and responsible way. So let's talk about, I want to ask you guys, who learns fast? Right? This is an intriguing concept, the backwards bicycle that we're going to talk about. Go look it up on YouTube. Google a lot of the things I'm telling you. Ask Uncle Google. On Google, go look up the backwards bicycle. Now, who learns quickly? Our kids, right? Like, think about it. When you learn that first freedom of riding a bike, you get on that bike, mom and dad are pushing you, you let you go. You turn right, the bike does what? It goes right. You turn the handlebars left, the bike goes left. And then you crash into a tree. You get scraped up, and you cry to mom and dad, and you get back on the bike and you do it again. Now, in this bike, an engineer and a welder decided that they were going to make the bike so when you turn right, turn the handlebars right, the bike would go left, and vice versa. How many people, show of hands here, how many people think they could ride this bike? I cycle all the time. I still think I could do it. Even I know I've watched this video many times on YouTube, and I would not have a chance. I'd be falling down. You guys all be laughing at me. But this is what we're going to be talking about today. We're going to be talking about how we've been, again, taught to surrender our money to others. We've been taught that we want to give up control of our money. We want to put our money somewhere else. We want to store it for our future, hoping for one day, someday. But like riding a backwards bicycle, we're going to start with two parts of infinite banking. It's the math and the mindset. So right here, we're talking about the mindset. How do we shift the mindset? How do we make it so you guys, so all of us here know that this is possible? It may be difficult as we get older, those grooves in our brain get deeper, but we can still learn how to ride a backwards bicycle, which is what we're going to teach you today, which is why I want you to keep an open mind. And if you don't know what I'm talking about yet, just give yourself permission that you don't know this yet, being the operative word. So back earlier, I talked about why only 5 out of 100 of those 18-year-olds will be successful. So why aren't more people successful? First, there's the mysteries of money, right? There's the wealth killers. And we all know when I ask what are the 2 pains in life, the first answer is almost always taxes. Second, we got inflation. I just watched a presentation by the chief investment officer of one of the 5 A+ rated mutually owned dividend paying companies we work with. And he showed that, slowly inflation's been coming back down. And he was saying, hey, it's at 2.8%. The Fed wants to keep it at 2. In my mind, I'm thinking, dang, man, I got 2 boys, and I'm pretty sure you guys can agree with this. It doesn't feel like it's 2.8%, right? He's like, oh, this doesn't include gas and groceries. I was like, oh, well, that makes sense. So it's still more like 8 or 9%. That's why our food bill is up by probably 30 or 40% week over week. And then there's the volatility, the up and the down, the booms and the busts, which is taught, in some of what we're learning in the Nelson Nash Institute, the practitioner, the IBC practitioner. We see why the government is really manipulating the market. You have the stock market up, down, up, down. It's a roller coaster that we're all used to riding. It's just part of our life, we think. And then we have the interest that we're paying out. Like, interest rates keep going up and up and up for all the things that we want to purchase. And then the other side, right? We talked about the math, now the mindset. We're following advice of our broke-ass brother-in-law or sister-in-law, or just random advice that we received during our life. We don't really take the time typically to learn what's really happening. And then we got the fear, the uncertainty, and the doubt. And so I'm going to offer you this simple financial philosophy. This is the first write it down point. There's more to be had from avoiding the losses than there is from picking the winners. Again, there's more to be had from avoiding the losses than there is from picking the winners. And this is what we're teaching you. How do you build a financially secure platform? How do you build something where you know that it's going to act guaranteed the way that you set it up for yourself, right? Or the way that it's built or specially engineered for you. So let's talk about some of the mysteries of money. So first, I'm going to ask you guys a question. What is the definition of money? I get a couple answers in the chat, maybe from Troy, Michael, Shauna even. What's the definition of money? I'm going to offer you a super simple definition. That's it. Teresa's got it. It's nothing more than a means of exchange, right? And thank God people decide like, hey, I don't want to carry my sheep on my shoulders anymore, or maybe I didn't want sheep at all. So we're going to figure out how we can just exchange money for the thing we want. So money for candy bars for money, money for phone for money, money for car for money, money for house for money. You guys get it, right? It is just a solution to a problem. It's a way that we can exchange value with each other. And it's only worth the value that we assign to it. Okay. So who uses compound interest? Now, everybody here is probably screaming, it's the banks, but it's not true. It's not true. Banks will pay us interest and they'll make interest, but they're not paying us compound interest, right? I know Einstein said that is the eighth wonder of the world, and we're going to dive into that later. But think about this. When you go to the teller and you deposit your money, you take the money out of your wallet, you get paid, it's Friday, you're happy. You go in, you hand the teller your money. They go back to the little box behind them and they put the money in there or into the chute and it's gone. Now, when you go back, if you wrote your name on that money, that $100 bill, will they hand you back the same dollar? No. Money, part of the magic of it is it has to stay in motion to make more money. It just follows God's law. And we're going to talk about this here in a moment. Here's one that gets a lot of people a little bit confused. Is money worth more today or in the future? And if you get confused, just think about if you took that dollar or that $5, how many candy bars could you buy 10 or 20 years ago? Probably quite a bit more than you could buy today. I could buy with a dollar like 2 Snickers bars when I was little. Today with that dollar, I could buy like a quarter of a king size Snickers bar, right? Taxes, up or down the future. If you guys need some help with this one, go to usdebtclock.org. Another thing to Google. Remember, we're making notes, not taking notes. usdebtclock.org will show you that we're over $34 trillion in debt. So do we want to pay taxes on the seed or the harvest is another way to ask this. So if you're thinking about the next question I'm going to talk about your retirement account, think about you're putting your money in and you have a silent partner. And your silent partner is the best, They don't bother you. They let you do whatever you're doing and you grow your company year over year over year over year until you get to retirement age. And now you've turned your tens of thousands or hundreds of thousands into hundreds of thousands or millions. And your partner walks in and goes, hey, Tess, hey, Troy, hey, Dex, hand over that 30, 35, 40%. We don't really know what it's going to be. But if we're betting that they're going to be less, go look where historical tax figures since 1913. We're in a historically low tax period, which doesn't sound like I'm telling you the truth, but just go look it up for yourself. And what do you know about your retirement account? If you're like me, this is what I knew. I'd go see the Schwab guy every year. I'd go in. I was all proud of myself. I'd put the max amount I could put into my 401k. And I would say, hey, retirement guy, how am I doing? Like, am I going to retire at 55 like I want to? And he would say, well, Jason, how do you feel about taking on more risk? I'd say, what? I don't want to take on more risk. I don't even gamble on my favorite teams. Like, I don't like losing money or even betting money. I like watching people gamble and lose money, like some of my peers I've seen in the past, but I am not going to gamble my money. So then his second question is like, okay, well, if you don't want to take on more risk, how do you feel about retiring 20 years later? And I was like, whoa, hold on a minute, man. I thought you and I were tight. I thought you heard me. You know, I'm in my 30s now, not now, but back then. And I thought you heard me. I thought you saw me. I thought you really understood me. Why are you asking me if I want to work till I'm 75 when I told you I want to retire at 55? And that was the moment where I knew something was up. In the back of my mind, I knew something was up, but I didn't start asking better questions until a few years ago. And so if you're hoping for one day, someday, that your retirement account's going to work out, I'll just offer you to learn more about it. Learn that you're really deferring is just a nice word for postponing till later. And you don't even have a contract that tells you, like the question that Brent always asks, can you ever lose money in the account? Well, the only guarantee in that account is it won't go below zero. It won't go below zero. So let's talk about I know this is a lot to absorb. I know that this is a lot to wrap your head around with the truths about money. Again, you've been taught the traditional way of thinking about money, but to truly build generational wealth, we have to challenge those concepts and understand how money really works. And we really want to look at cash flow being the number one guide. So let's talk about the money multiplier method. It's only 3 parts, right? We're going to talk first about the machine. The machine, what is this magical machine? Well, I'm going to tear this down and show you what it is in a few minutes. Let the cat out of the bag, if you will. And then we're going to talk about a marathon. And I love saying this. I personally don't do marathons unless, and by the way, the first marathon I ever did was slower than Oprah. So I'm not fast if you're thinking that. But I don't do a marathon until I swim 2.4 miles and ride at least 112 miles, right? And then I'll run a marathon. That's the only time. So we want to think long term. That's why I'm anchoring that long distance in, thinking long term. The machine, the marathon, the 3 M's for alliteration, and the millionaire, right? If you want to be a millionaire, or not just a millionaire, maybe a multimillionaire, this is how we're going to map it out for you. So what is the machine? Let's see it in the chat. I know some of you know what this is. You know, what is the machine that's going to help me build, keep, and create more wealth? Drum roll, please. What is the machine? The machine is nothing more than a dividend-paying, whole life insurance policy from a mutually owned company. It's a specially engineered, cash-rich, whole life policy. You might say, whoa, wait a minute, Jason, we're 23 minutes into this, and now you're telling me it's life insurance? What? Like, I'm going to run out of the room. I ain't coming back. I ain't listening to this anymore. Well, what I'm going to show you on our next slide, which is an interactive T-chart, I'm going to skip through something real quick here, is we're just going to look at what the biggest purchasers of this specially engineered whole life and why they're purchasing it. And then you'll start seeing, like Einstein says, you know, first we have to know the rules of the game, and then we want to play better than anyone else. So yes, Dex, as Brent says, I like to say specially engineered, cash-rich whole life, because that tells people, ooh, cash, something I can use in my day-to-day. So let's jump into this. Oh, I got to fast forward. Okay, we did it. Let's jump into this T-chart. Here's a fun, everyone get your pens, your paper, your crown, you know, whatever it is that you're going to draw with. And on the top left, you're going to write bank. The top right, you're going to write policy. Under bank, you're going to write liquidity. Under policy, you're going to write liquidity. And I'm going to ask you, do you know what liquidity means? And then I'm going to tell you, yes, you do. It just means the money is accessible. Like if you go into your bank, you can get the money out and use it. Same with a policy. Now in bank, we have 0.07%. 0.07%. Woo, that's a pretty big number. Under policy, we're going to use one of the 5 mutually owned dividend paying whole life A+ rated or better companies, 3.25%. Now that is uninterrupted and compounding, guaranteed contractually. First guarantee of 2. The bank, taxable. All of that growth on that 0.07% is going to be taxable. Well, that's not very fun. And then on the policy, it's all tax-free growth. It's going to be tax-free growth, tax-free distribution, tax-free loans. It's all tax-free because why? Your money's being taxed now when it's the seed, and as it grows into a harvest, it's all tax-free. That's what we want. We want to pay Uncle Sam once and no more. And then for the bank, it's unstable, right? It's unstable. What do I mean by unstable? Well, think about the beginning of last year, 2023, the Silicon Valley Bank and the banks that followed, and then there's more later in the year in New York and then the Midwest, and there'll be more. I believe there'll be more. But banks, since they don't keep the money, since they practice fractional reserve banking, banks, we shouldn't have all of our money in one bank. Play the shell game, spread the money out, because banks aren't stable. And I've heard that from companies that invest in banks. They were shocked what happened with Silicon Valley Bank. They were only able to draw a small percentage of the money. When they had been taking millions out per week, they were limited because it's an unstable environment. So the policy, it's stable. And what do I mean by stable? I mean profitable every year they've been in existence. So 147 years, 137 years, 160 years, 100 plus years. Every one of the companies that support infinite banking that we work with, and remember, we don't want to be beholden to any one company. So we work with multiple ones to solve your problem. And so they're stable in uncertain times, economic times, through everything you can think of from 1913 to today. So the World War I, II, Vietnam, coming off the gold standard. Everything been profitable every single year. In the bank, your money's unprotected against judgment and liens. So if you get sued, they get hurt, you're an entrepreneur, they get hurt on your property, they get hurt, in your business, that money can be accessed by a good attorney, right? Liens and judgment. Well, in the policy, it's protected against liens and judgment. And so now here's the big question for all of you. Remember, interactive. Oh, wait, there's one more. That's all the living benefits. Sorry. Got ahead of myself. So with the bank, the money you have there, there's no additional plus with it, right? It is just no death benefit. It is what it is. You take the money out, it goes back to zero, okay? In the policy, even if you borrowed your cash value, you still have a tax-free guaranteed death benefit, the second guarantee, that's going to be a multiple of whatever the amount of cash value you have. And that's going to be a guaranteed estate, the legacy piece for your family or the things that you love. And by the way, as Chris would say, or even Brent, if there's not something that you love or a cause that you love, then you're probably in the right place. I know that's not any of you because you guys are all the 5%, but it really is, at the end of the day, the highest vibration is about love, about service, about helping others. So my question for you is, where do the banks keep all their money? I know you guys are saying, well, obviously it's not in the banks, right? No, banks have quadrupled the amount of whole life. Again, another Google fact check for me, please. There's one or two more coming through this presentation as well. But where do the banks keep their money? They keep the money in specially engineered whole life. That's why there's so many VPs at the banks. Every time, your bank opens a new branch office, think how many banks are in your hometown. The banks have more whole life, look up BOLI, bank-owned life insurance, than they do in buildings and land combined. $202 billion and counting. $202 billion and counting. So if that doesn't make you think, if the banks are keeping their money there, where should we keep our surplus money? Remember, we're just changing one thing. Where does our surplus money go first? So now I'm going to show you guys something that took me 19 times to get it. So if you get it in the first time, second time, congrats. But we're going back to pretend land. I'm going to be Jason the banker. And I'm going to show you how your money flows. So in our pretend world, remember we showed you 0.07%. But we're going to say you've been like Sally Saver. You have discipline and you've been saving your money at a conventional bank. And the money I am paying you, because I'm just a great guy, I'm paying you 4% on your money. And that money is growing in there. It's uninterrupted because you're not using it for anything. You're just being disciplined. You're saving for this new vehicle that you're super excited to get. Now you come into me and you're like, hey, Jason, I've been saving for the last 3 years and I've got my car picked out. I didn't know what I wanted 3 years ago. I knew the color, but now I know the car. So get that car in your head. What car would you guys want? If you could pick any car, participate. What would you want? What would you get? Like, would you get a certain truck? Would you get a G-Wagon? Would you get, I don't know, a convertible, an older car, a muscle car? Like, what would be an e-car? What would be your dream vehicle? Think about it. Put yourself there. Now you come into me, you're like, Jason, I want to take that hard-earned money out. And Michael wants a Hellcat. So Michael comes in and says, hey, I want to take my hard-earned money out of the bank and I'm going to go buy this car with cash, right? There's 3 ways to buy a car, which we're going to go through in the next set. But you come in and you're like, well, 4 if you count leasing. But so you come into me and I'm like, hey, Michael, just hold up. What if I, being your buddy, you've been keeping your money here. I've been giving you 4% because I'm super generous. Just leave your money here. You're going to go buy the vehicle. You're going to finance it over the next 60 months, next 5 years. I'm going to give you a loan for $25,000 at 6% for 60 months. And if you leave your money in the bank at $25,000 for the next 60 months, you will make money. Do you believe that I'm telling you the truth? Do you believe me? Most of you, Michael believes me. Most of you say no, Jason, because 6 minus 4, or 4 minus 6 is -2. I'm losing 2%. But if we do the math, 25,000 at 6%, the payments on that is going to be $483 and change a month. Okay. So the total future value, if you use a time value money calculator, a future value calculator, $28,999. So 29 grand. And now, if you look at the future value, if you left the money in the bank at 4%, you've earned $30,525. Now, I don't know about you guys where you're at. I'm here in Florida. The way we do math, $30,000 is still more than $28,999 by a little bit, right? $1,526. So we've made money in that inverse scenario. And that's something to keep in mind as you're learning more and more about the banking structure. So let's talk about, how do the banks make money? Again, remember, keep an open mind. This might get a little bit wild. You might get a little bit upset, but the banks, remember, super generous banker, my bank's still paying you 4%. You deposit $100,000. This is how banks work. When we make that deposit of $100,000, is that a asset or a liability? Some of you are saying, well, hey, it's got to be an asset. You just gave me 100 grand. It's actually a liability to the bank, right? Because the bank in the fractional system is going to lend out 90 grand immediately. And that's going to go out to someone that needs a new home. And they're going to charge 7% for that. Now that's going to go to the seller and it's going to come back into the bank. And the bank's going to do what? They're going to lend the money out again, keep the money in motion. Banks are geniuses. This is what we're teaching you. Do and work like the banks do. Just through your own system, not the banking system. And so now we lend it out for a car. The banks are lending it to a car and they're charging 8% this time. Comes back from the car dealer, back into the bank, goes out for the home remodel. So 9%, because every single one of these has a little bit more risk, a little shorter duration on the loan. So they're going to charge a little bit more. And now it comes back from the contractor and it goes out one more time, because now the US has over $1.1 trillion in credit card debt and we're saving very little. So we're going to go out for a debt consolidation at 12%. Now that comes back. So in all of these scenarios, how much risk is the bank really taking on? Not much. Not much. They're like Ricky Bobby's dad. If you ain't first, you're last. The home, they're in first lien. The car, same thing. The home remodel, same thing. Right? The only one that they have the risk on is the credit card consolidation, but they're the ones that have created the mess in the first place. So they're just selling off that debt to somebody else. But anyhow, that's a whole nother rabbit hole. But let's look at the spreads of each of these. So if we do 7 minus 4, we get 3%, right? 8 minus 4 is 4%. The next one, 9 minus 4 is 5%. See, this first grade math's really, really useful. And then 12 minus 4 is 8%. We add all these together, what do we get? We get 20, right? Remember, the bank was paying us what? The bank's paying us 4%, and they're making 20%. So how much more is that than us? Is it 16%? No, it's actually 5 times as much, or 500%. 500%. So when we look, if you understand that the banks, and you can, another look it up moment, BauerFinancial.com, banks make 400 to 1300% on every dollar that you leave in the bank. What? So wait, they take our money that we've worked so hard, we deposit it there, and the banks are making 400% more on the money that we just made? Yes, why do you think they give out the little, cherry flavored and root beer flavored and pineapple flavored dum-dums? You think they're trying to tell us something? So this is what the banks are doing with our hard-earned money, okay? Now I'm going to show you what we're doing with our hard-earned money. It's even more shocking than what the banks are doing. So let's look at this. Let's look at our annual pattern of spending. And this has been the same since the 1940s and getting worse, actually, not better. So again, remember, we're groomed. Remember, once we have those deep grooves, it's really hard for us to learn something new. So let's look. We're paid for every dollar we're paid. We have 20 cents of every dollar. If you have a Hellcat, maybe a lot more, Michael, or Hellcat, 20 cents of every dollar is going towards our automobiles, okay? The next 30 cents, so we're at 50 cents already, is going into our housing. Then we have 40% for everything else. We have our fun, we have our utilities, we have our food, everything else. And then that leaves us with 10 cents of savings. Now the actual number is a lot worse, but we're being generous. We're saying, hey, we're going to pay ourselves first, at least 10%. That's what they talk about in The Richest Man in Babylon, and Rich Dad Poor Dad, and Think and Grow Rich, and many other of the financial books out there. They always come up with 10%. I think it's a biblical number as well, 10%, because that's what you're paying yourself before it goes to anyone else. So let's look at how much of this is interest, right? We're losing 34 cents of every dollar to interest. So the first 5 cents of interest is in our automobile. Remember, it's not the percentage, the APR of your 3.25 or 4 or 5% loan. It's the volume of interest over time. So we're going to recapture that. This is a recapture and recycling part, and put it back into our savings. The housing, if you bought a house in the last 5 to 7 years, please don't do this. Please don't go look into your housing statement. Don't do it. You'll cry. I promise. You're giving up 70 to 80% of interest to the banks. So basically 25 cents of those 30 cents is in interest. What happens if we make that go back to our savings? Okay. See how this is starting to get a big slice of the pie? We either make interest or pay interest or earn interest. That's the message of what I'm showing you in your annual pattern of spending. The next 40 cents of every dollar, we'll call it 5 cents. Probably more, because average credit card right now is about 22.5% or 23%. So now we moved all that back to the savings. Could you imagine with every dollar that you made, if you're getting this much back and you could spend that? This is the first step in building, keeping, and creating more wealth. Now we're going to go to a lot of people's favorite part. How do we make money? Tess knows, how do we make money for every car or truck, if you live in Florida or Texas, for every truck you will ever buy, drive, and own for the rest of your life? Let's peel back, open the hood of the machine, peel back the layers, and look at this together. So remember, we're going to go through this, and we're going to talk about the premiums as a premium deposit. most insurances, health insurance, auto insurance, home insurance, the question we ask ourselves, remember, paradigm shift, thinking differently. The question we ask in insurance is how much coverage can I have for the smallest amount of monthly payment with a reputable company? Meaning, if this happens, if my home burns down, then I'll get money to rebuild it. If I'm in an accident, I'll get money to get a new vehicle or a vehicle like this. Our question here is how much can we put into our system? How much of a premium deposit can we put into our banks? A premium deposit. And what doesn't matter here? Our age doesn't matter, and the death benefit doesn't matter. So with this system, I'm going to show you that we're going to buy a car in year 3. And every year, we're going to deposit a premium deposit of $10,000 into our account. So as you see, we put $10,000 in year 1, year 2, year 3. And in year 3, we're going to pull a $25,000 loan out of our policy to buy that new car, that new shiny red car we want. And remember, it doesn't matter if it's a, just add a 0 if you're buying a Ferrari versus the Focus, right? It doesn't really matter. Now we're going to be an honest banker. We saw the example earlier. We're going to pay ourselves back with interest at $500 a month or $6,000 a year. And we're going to do this from years 3 to 7. So for the next 5 years. At the end of this time, we're going to have paid $70,000 of premium deposits, $30,000 back to ourselves, right? Because now we're the banker as well. So $100,000 minus the $25,000. Well, how much do we still have in cash value, right? That equals 60 or 75,000. If we look right above that, we still have almost 68,000 in cash value. Meaning, remember how I said you're going to get back money on every car you drive, buy, or own? We've recaptured 91 cents of every dollar by just taking on the banker's job in this equation. So let's look. Now, what I'm going to show you next, I would never, ever mentor you or recommend, but this is just to show you how powerful uninterrupted compounding interest is. So it gets better, right? Not only are you getting 91 cents back, but let's look what happens. We're not going to put anything into our policy, no premium deposits after year 7. So nothing into it. We have the cash value to buy another car. Now we're going to, we're going to get a new vehicle and give our old vehicle to our teenager. Now they're old enough to drive. They get the 5-year-old car. We get the new car. We're the parents. We're putting up with all the nonsense, paying more insurance. So we're getting that new vehicle, $25,000. Again, if you want a Ferrari, just add a 0 to your equation here. You're going to pay yourself back. Again, you're going to be an honest banker. And at the end of this, 5-year period, you're going to have paid $30,000 into the policy. Okay, back to yourself, into the bank. No deposits. Minus that $25,000, it gives you $5,000. But look at the difference. If you do $91,473 minus the $67,000 before, you've actually now have made $23,592 on your second car. So you put no extra money in, you've paid yourself back as an honest banker, and you've actually made money on this second car. And just think, every car after that, you're going to make more and more money. More money. Give me like a double high five in the chat if that's exciting to you, if that makes sense. So let's look at some of the rules, the 3 rules. So rule number 1, let's see. Here we go. Rule number 1, rule number 2, and rule number 3. Let's pull up the 3 rules for you guys. Number 1 is pay yourself first, as if your life depends on it. Yesterday, I wrote down this. I said, what if it's policy first? Instead of pay yourself first, what if it's policy first? We must pay ourselves before we pay everyone else. Think of the first 2 commandments. Love God, heart, mind, and soul. Love thy neighbor like thyself, who's number 2? Thyself. Or when the oxygen, if you don't like that example, when the oxygen mask comes down on the plane, we have to put the mask on first before we help anyone else. It's the same with our money. We have to respect our money and ourselves. We want to pay ourselves first, as if our life depended on it. Number 2, we want to pay ourselves back with interest. Remember, you're either paying interest or you're what? You're earning interest. And number 3 is we want to recapture and recycle all of that money. So if this works, for the car, every car or truck you're going to buy, drive, or own, what else can this work for? What else can this work for? Let's go into where most Americans, most of the 2,500 calls I've had personally, most folks have debt. At least 2 of the 3 calls today were about debt, about helping someone really recapture and recycle and turn their assets in to, so we're going to go to this doctor. This doctor's 45 years old. He's got 9 third-party debts. He's got a total debt of $478,774. Pretty common. And he's saving about $25,000 a year. And if he makes the payments, the $5,777 a month that he's paying right there, and you see the interest rates in the middle, it's going to take him 19 years to pay off this debt. And this is a chiropractor. This is one of our actual clients. And so now we're going to see, well, what happens if he puts this $25,000, remember, money he's already saving, into a specially engineered whole life. So year 1, he's going to make that premium deposit, and he's going to immediately, in the first 30 days, take out a loan for almost $15,000. And what's that going to pay off? It's going to pay off his Discover, his Lowe's card, and he's going to recapture $448 a month. Remember, the rules of being an honest banker. We don't want to steal the peas. So we're going to fast forward to year 2. In year 2, makes a $25,000 deposit. Now he takes out a little bit more because it's getting more and more efficient. He's got $16,571 to use from the policy. He's paid himself back that $448 times 12, which is a $5,300 and change. He's going to knock out the next 3 debts, the Nordstrom, the Wells Fargo, and the private loan. Now he's getting back almost $24,000 a year. Okay, almost $24,000 a year. Year 3, he makes a $25,000 deposit, and it's already reached its efficiency point. Some of my teammates call it a cash, the cash tree, where he puts in 25. Now he's got an extra $541 he can use, and he's paid himself back, like I said, almost 24 grand. Now he's going to knock out the BMW, knock out the West Marine, his boat loan, because of course he probably has a lake house. That's where the condo is, and he needs a boat, right? Who doesn't? So now he's got $3,600 coming back, almost, close to $48,000. And so we go to year 5. How much do we put in? This is going to blow your minds. If your minds are already blown, how much do we put in? Year 1, $25,000. Year 2, $25,000. Year 3, $25,000. What were the loans for? We got 14, 16, $25,000 for a total of $55,000. How much is left in your policy? What's that difference? 20 grand, right? 20,000 makes sense? That's easy. No. Actually, all 75,000, remember, this is a save and spend system. If you didn't get that earlier, all that money is still compounding, earning you a guaranteed contractual interest rate and most likely a dividend. So in year 4, we deposit the 25,000. Again, the value goes up more. We paid ourselves back, and now we didn't quite pay off the condo, but we're getting there. Year 5, we deposit another 25 grand. Money goes up again. Got payment backs of 44,000. We got 71,000 in cash value. Guess what? We're going to pay off the condo, recapture another 312, pay down the house, recapture a little bit more money. We get to year 6. Now in year 6, what happens? We're at the point where we're recapturing so much money that we need another warehouse for our wealth. So we're going to deposit 10 grand, right, into our first policy. We're going to deposit 25,000 into a second policy. We're going to pay ourselves back 54 grand. Now we got 2 policies. We've increased our legacy. We've increased the warehouse for our wealth, and you see why later, and we're going to pay off the house. So now it's taken him 6 years. This doctor, 6 years. Remember how long it was going to take him? If you remember, throw it in the chat. How many years before? It was 19, right? 19 years paying $25,000 a year, paying interest out to someone else. When he recaptures and recycles this interest back to his family, look what happens. His wealth grows just by an infinite amount. And now, one of the most exciting things is this year, we've added some new tools for you. I've just included the debt blaster. These used to be after your policy was in force. Our implementation team, right? Because knowledge isn't power. You need someone to help you apply the knowledge. But now we will do this after you do your paramedical. Now you heard me right. It's a free service we're offering you. So we can show you, is the snowball, the debt snowball, going to be the fastest? Is the avalanche going to be the fastest? How long is it going to take to pay off all your debts and to only owe yourself? And then how long will it take you to pay yourself back? Now, if you don't have debts, that's okay. We can show you a gain projector. How can you take the money and put it to work and something you know, like, and understand? Remember, I'm not a financial advisor. If I haven't said that before, I'm just a dude. I'm just a guy who learned about this, and it's changed my family's life. So again, the knowledge isn't power. The debt map is something that you will still get once your policy is in force. Your implementation specialist is there to hold your hand. We're professional hand holders, folks. We are teaching you how to fish because we don't want to do it for you, but we do want to make sure that you really know how to put that, put the bait on the hook, cast, catches what you're going to catch, take it off the hook. And if you want, we'll even cook it for you. So this is why I partnered with the Money Multiplier, and it scales everything we do. So back to one of my favorite questions. You guys know this question. How do you eat an elephant? Well, one bite at a time. It seems like a big task, but we're going to have some elephant stew, some elephant steak, some elephant salad, maybe some soup. Who knows? We're going to find a lot of different ways to make the elephant taste good so we can eat and feed our family for a long time. And think about this. The man at the top of the mountain didn't just fall there. When you see someone successful, when you see what Chris Naugle's built, or Brent Kessler, or just think of anybody, Elon, or anyone else that you see successful, anyone in your life who you admire, they didn't just fall there. The man or the woman didn't fall there. They had to take the steps to get there, right? And the progress is what makes us happy. Diana, I love that you're putting your takeaways. So at the end, right, we saw what he paid off of the debt. So is it possible to owe no man nothing? If this machine works for debt and expenses, then it can work for anything, right? Anything we can think about. Our fifth principle is rethink your thinking. So it can work for your vacations, for your homes, for taxes, tuition. I use ours to pay our payroll taxes. And by the third year, I'll make money with my payroll taxes. Is that fun? I mean, it's maybe not fun, but it's way better than giving Uncle Sam my money. We're only limited by our imagination, So if we continue to pay back the homes, the condo, and the house as promised, look at these numbers, right? I said it can get even better again, but wait, it gets better. So now we've recaptured what? Remember, we're mapping out a millionaire mystery. That's $500,000, folks, right there. Now we add the 4% interest rate, and what happens? Woo! We're at $750,000, and we didn't do anything except change one thing. Where does our money go first? So now that you know this, the biggest regret that we hear from anyone who started, from Brent Kessler, from any of us, is this. My biggest regret is I didn't start sooner, right? My biggest regret is I didn't start sooner. Now that you know this, you can't unknow it. And if you're not setting us up for your kids or your future kids, your grandchildren, remember, we're thinking long term, as Tess just said. We're thinking about a marathon. If you're not doing this, then you're stealing from your family. It's that easy. And by the way, I did talk about some of the stuff, so I'll probably remove this slide, but we didn't really talk about the death benefit, the second guarantee, the legacy piece. We didn't talk about the loans never needing to be repaid, even though when we're working like an honest banker, we do want to pay them back. We don't want to steal the peas from our best business, which is banking. And the internal value grows tax-free. Remember, there's no Uncle Sam silent partner at the end saying, hey, psst, give me my slice. And the policies give you more protection. So when we look, why do the banks have so much bank-owned life insurance? It's simple. These are the most secure financial institutions in the world. Like part of their book of business is lending money to the banks, hundreds of millions of dollars. There you go. And so, as our buddy Warren says, right? What's Warren's first rule? Remember my philosophy I gave you? The philosophy that is for your financial philosophy. There's more to be had from avoiding the losses than from picking the winners. Well, what's Warren's first rule of investing, right? Don't lose money. That's right, Troy. What's the second law? Don't lose money. So, as Warren said, if poor people would just do what rich people do, they won't be poor anymore. And that starts with the shift in our mindset. If we look, what's going to happen? Now, I've not met anyone who could tell me that this is not going to happen. Only one of two things is going to happen in our life. We either live or we graduate, we die, we shuffle off, we're no longer here. Are we better off? Is our family better off if we have the policy? With or without the policy? Timothy knows that. We got to put our little green men to work. So now that you guys have seen this, you have a choice to make. The choice is easy. You can either continue learning about this, stay in our ecosystem, learn from our various YouTube, from Chris Naugle YouTube channel, from my YouTube channel. There's just Jason Sipple, from Brent and Hannah, podcasts. We have Devin Burr. We have a ton of information out there to teach you guys, to educate you. Or you start your application process. If you're ready to take back control of your money, it's simple. Book a call with me. The decision is yours. Here's the reality. Some of you are going to take action, some of you won't, right? The most uncomfortable thing is taking action and working through it, but you can book a call here. It's the jason.beyourownbanker.com/30. Book a call with me. I will meet you where you're at financially. Myself, the money mentors, our team, we're here to guide you. We're here to give you the tools, give you the implementation. We got 2 minutes left. I'll stay for as long as you guys want to hang out. But who's got some questions? I really, again, appreciate you. I'm grateful for you. You don't understand how much it means to yourself that you're here. This is about you being the 5%. You're doing what 95% of people will never do. They're not going to dedicate their most valuable resources, their time, their energy, their focus to learn something new. Someone put in the chat, I want to hear, what is your making notes? What is the thing that you're going to do today? Sean says, how do you engineer the policy? That's an awesome question. So it is a multitude of different things, but first, Sean, we want to know what we're solving. We want to know what we're solving. So if you make an appointment, we can go ahead and meet you where you're at and we can talk. Is it the debt problem? Is it you have lazy money you need to park and protect? Next time I'll make a slide with the 5 most common things. I have not shared this with anyone else, so you will be the first to see this. These are the 5 most common things that people come to the Money Mentor call with, the strategy session with. One is recycle debt. How do we use the policy to recapture and recycle the money, like we showed with the doctor's example of getting out of debt in 6 years versus 19 and bringing all that money, $750,000 just from the 2 homes back to his life. Second is the car example, how we fund major purchases. Third is if we have lazy money in a money market, or I talked to a woman today who had her money in a high yield saving at 5%. And she asked me, is this better than that? And I said, well, it's great. Your money's earning 5%, but it's growing tax-free. It's not protected. It's not uninterrupted compounding interest, because if you pull the money out, it won't keep growing. So we want, number 3 is to protect your money. Number 4 is the finance education for our kids. Like college is getting more and more expensive. Now, so are, primary schools, secondary schools. It's expensive. So how do we give our kids the best start on life other than teaching them financial literacy? And finally, building, keeping, creating more wealth, putting our little green men to work. That's the 5th thing. So Sean, first we want to know what you're doing, and then we're going to engineer the policy to give you a large portion as cash value, the base, which is the chassis, which has to be whole life. It has to be whole life with a mutually owned dividend paying whole life company. And then if we need to, we can overfund it. We don't need to, But in some cases, it makes sense on the immediate problem. But remember, the goal is to help you guys think long-term, to think 10, 20, 30 years down the road. So I hope that helps. So how do you actually take the money out of the policy, and what is the type of policy needed? Thank you, C. That is for same what I was just saying. You take a loan against your cash value. So you have to put money in, premium deposits in. You take a loan out from the insurance company's general fund. So you borrow against your money. You have your money in the left hand growing forever. You borrow from the insurance company. And then the type of policy needed is what we're talking about. It's a specially engineered whole life policy that someone that knows what they're doing is designing. So either someone from the money multiplier, there's a couple other of our, peers that are doing this right. If it's IUL, just run the other way. I've already had 2 conversations today out of the 3 that someone was sold an IUL by a friend, a frat brother, one of the guys. I'm like, oh, is that guy really your friend? So how much life insurance is needed to purchase a policy like this? My debt is $200,000, please advise. Now, MG Fraser, it's a great question. I would want to have just schedule that call, with Jason at Be Your Own Banker, and I'll help you establish that guideline. If that 200,000 is your mortgage, then maybe that's not the best use of if you had 200,000 in cash value. So it's really going to depend on where you're at financially today. But we can, and it's not a question of how much life insurance, it's more of how much are you depositing to solve the problem. What other questions do you guys have? You're asking great questions. I love Troy saying, take the action. Be like Nike, just do it. If you think you're ready to do this, just do this. If you're not, it's okay. Go just learn more. Sean, you want to come back on? You've had your BYOB money school thing there the whole time. There you are.
Here.
It's like
No,
doing an Ask Me Anything with just you and I.
I know. I think it's great. I appreciate the call.
It's always fun. It's always fun. So I'm glad to see this this little thing looks really rich, doesn't it? That guy's sitting there looking, man, that's my future. I'm gonna walk into it. I'm gonna be rich by following the money multiplier method.
There are 2 questions too in the chat box. So Susan saying, how does the extra loan paid back affect the MEC?
Okay.
Did you get on that?
I can answer that. Yep. So Susan, it's a great question. Everything we design, one of the questions I ask every day is, can you put 16 ounces of water in an 8-ounce container? I know you're saying no, because if you tell me yes, I can't work with you. I love creative people. I'm an artist myself, but if you think you can put more into an 8-ounce container that can hold, then we can't help you. This is why Chris has 10 policies. I have 4. Brent has 28. You're going to get to a point. Shauna has how many? 3?
3.
Yep. So you get to a point where you can't fit any more of that money. So it's going into your segregated account. You can't put it back into your policy. There's no more room for paid up additions to go back into it. We're going to open another warehouse on 3rd Street, 5th Street, 7th Street. So that's a great question though, Suzanne. Thank you. You said there was another one, Shauna?
Yep. C4 is saying, how do you actually take the money out of the policy, and what is the type of policy needed?
I think it's very much like the question that MG asked,
Yeah.
right? Or C4. Yeah, we answered that one. So that one is you're borrowing against your money. So, but it's good to hear it again. So think of it this way. I wish I had a couple $100 bills here. So if you have, I'm going to use these. You have $100 or $1,000 or $10,000. Let's make it $10,000 that you've deposited into your account of cash value, right? In this hand, the life insurance company is also going to have $10,000. You're going to borrow the money from this hand. This hand's never borrowed. You're just collateralizing. It means borrowing against this money. So that's a fancy word, the life insurance word, but you're never touching this money. This is why it grows uninterrupted and compounding forever while you borrow from this hand. And this is what you're paying back because you're not a dishonest person. C4. I know you're not. You're an honest banker. Besides Google, Martin, besides Google, what other resources can you share to explain compound interest? Well, you can go to Chris Naugle's YouTube channel. He's got multiple compound interest explained. I have one. I mean, you can look at it there. It's really the question, Martin, do you want a penny today that's going to double every day for 30 days or $1 million? The answer, if you haven't seen that, might shock you, but if you ask Google that, it'll give you many examples there too. on that one example. Compounding interest happens later, which when we said age doesn't matter, it doesn't matter because you're creating a banking system. But the younger we are, like when I started a policy for my 9-year-old last year, by the time he's 67, we'll have put like 300 and some $1,000 into the account. He'll have $1.4 million that he can borrow from because of the compounding interest. It just gets bigger and bigger and bigger the longer we go. Like it just starts doubling at a really ridiculous rate. So I started learning about this 8 months ago. Totally changed my life. Thank you, Lucy. I know you've been around the campfire for a long time, Lucy, so I love seeing you here. Okay, whole life from Mass Mutual. Jeffrey, that's awesome. You can borrow against that. I have my friend who didn't start the policy with us, who's going to pay off his car from a regular old whole life Mass Mutual policy. So super valuable. Can we set this up in a Roth IRA or under a company structure? You can set up, there's corporate owned life insurance. So we can do like key person, we can do buy sell agreements, we can do different structures. It's a little bit more involved, but it's not hard to do. So you can do it under a company structure to keep the money in the company, have the company fund it, protect the company. But you're going to get also with that, we can help you. We can walk you through it. We're doing it with a lot of our clients at the moment. So it's just a little bit different than setting up on your own body. You still need a body to insure. It has to be an insurable interest. But yes, we can do that. So, all right.
Yeah, but not with a Roth IRA, right? So like the
No.
Roth IRA is separate. But if you like a Roth IRA, then you're gonna like IBC because they have the same similar concept of paying your tax on the seed, getting the seed to work, and then enjoying the harvest.
1,000,000%. The biggest difference in the Roth is one, the Roth is limited. You can only put so much money in. There's qualifiers. Some people make too much money to put it into a Roth. The Roth is also, even though it's tax-free growth, it's tied to the market. Personally, I don't want anything tied to the market. Like if I'm gonna put everything through my policy, and then from my foundation, it'll go out into the risk bucket, which is investment. So if I believe, like if my buddy Jeremy teaches me at one point how to, day trade or do the stuff that he's done to become a multimillionaire, he keeps asking me, like, simple, you don't like Apple stock? Like you don't like, stock in the tech companies? And I'll say, no, I don't know what I like. Like, I don't want to invest in the market. But he's telling me, but if I did that, it would come from the foundation first. So Jeffrey says it takes a while to build up cash. It depends, Jeffrey. Like if you did a regular old Nelson Nash 60/40, you would in year one, if you did 10,000 a year, you'd have access to about 5,800 in year one. So 58%. Year two, it's about 70%. Year three, you're about 80%. By year four, it's about 90 cents of every dollar or dollar for dollar. By year five, you're getting over 100% return. We hit the cash tree. So not only can you, in year one, you can spend 58% of the money that you put into a regular old Nelson Nash engineered whole life and use that money to do something in your life, but you're also earning uninterrupted compounding interest in your other hand. So,
and I couldn't agree more. And I think my policy is about on its 5th year, and I think it's a 60/40. So I'm like hitting that money tree year. But then to that point is, I don't know, it feels like I blinked and it went from 2020 to 2024. So
yes.
It does quote unquote take time, but I'm thinking the time's going a little bit quicker than it used to when we were younger. So it's
Jeff's the one that has the
goes
mass
with us.
policy. So Jeff, that might be all base, and that does take, 7 to 10 years to really start seeing a cash value. But I wouldn't, if you got that just to protect your family, it's super valuable because it's going to keep growing and growing and growing. Like a regular old whole life, if you have the patience, it's going to outperform in the long run because you'll always be putting in the premium deposit as a whole base. Like they're not building any cash value into it. It's not engineered. It's just a regular old out of the box whole life, but it's super valuable. Like I've talked to people 15, 20-year-old policies, they're putting $1 in, they're getting $4+ back, right? Because they're putting a ton of money into it. So
before we end too, can we take a roll call? Like who is new to IBC and who doesn't have a policy or anything like that? Just because I just really love thinking of the Roth IRA. Like if you understand a Roth and you understand why you're like, yeah, sign me up. I can put my after-tax dollars in now and then like it's unlimited growth. If you can even just think of that as your first stepping stone into understanding IBC, just continue to come back, continue to learn, but just like pair it with something that you already understand.
That's a great, Shauna, you always have great points. I'm glad you came on camera to share some of them. And what Tess just said, I talked to a detective, or a former detective and future detective again yesterday. And I just told him, Tess, I'm like, hey, you guys, you see the worst of people. And remember when I talked about mindset, we either think we can or we think we can't. Either way, we're right. So if you believe that you want to be your own bank, and if you believe that you can have the discipline to pay yourself first, to put yourself and your family first, to love yourself, then you can do this. If you're someone who's always think that someone's going to screw you over, you've lost money in an investment, someone's taking advantage of you, then this is going to be really hard for you. It's going to be really hard. And Tess, we should have Tess do a testimonial at some point about where she was 5 years ago. And I don't just mean like the one she's written us, but one on camera talking about what she did as a sheriff, what that felt like, what that was to overcome it, because about 1 out of every 10 sheriffs or detectives or people in law enforcement I talk to will move forward. All of them want to, but they just get stuck because they're like, someone's going to rip me off, or I don't know about this company. I haven't heard about this company because they don't own football stadiums, right? Like their name's not on the side of a football stadium, but they're a $120 billion company or $200 billion company that have been profitable for 147 years. So
I'll also be honest too, is I'm not an agent and I just work here, right? So I even when I started my policy a few years ago, like it's on my 5th year now, but I hear this stuff every day and I work here and I didn't really like, I still didn't even really get it even when I was going through with the policy, but I was just like, I will get it, at some point. So I just started the ball rolling. I'm not, disclaimer, I'm not trying to ever tell somebody to get involved in something that they don't understand. But if like your general gist is like, this is the direction for me, I just started it, signed on the dotted line, and I was like, I'll figure it out as I go. And I did, you know what I mean? It did change my life too. And
it does. And we're not saying that anyone should start this. That's not
no.
right. Keep learning. Actually, if you're not a 10 of a 10 that you want to move forward, I will not move you forward. And back to C4's question, we actually work with 5 different mutually owned dividend paying whole life companies. Why 5? I said this in the presentation, I believe. I said it twice. Is because we don't want to be beholden to any one company. We don't want them making changes and dictating to us how we teach banking. The ones that we work with, I've got a great new pyramid that I'm waiting for that I will share in other presentations. But the ones we're working for, we have certain qualifications we're looking for. They need to be profitable for over 100 plus years consecutively, right? At least 100 plus years consecutively. They need to be a mutually owned company, right? Mutually owned, not stock owned. It has to be about you being the policy owner. That's mutually owned. There has to be, they have to be A+ rated or better. There's 15 ratings. There's 2 different rating systems for whole life companies. But out of the 15 ratings, all 5 of the companies we work with are in the top 2. Actually, the one that's the highest rated is the one we work with the least, because we don't feel like their customer service is the top for our people because they're trying the bank. Like today, I took out a policy loan on the 6th. It's going to hit my account either today or tomorrow, I was told. But I called the company today and said, hey, I'm, Jason Sipple. This is my ... This is my policy. I took out a loan. I'm just following up. Like, oh, that's great. It shows that's processed. You'll either get it today or tomorrow. If you call a couple of the other companies that we could help you with, you might wait for 45 minutes or an hour. So part of it is like, how friendly is the banking part of our experience? So C4, there's 5 different companies. I mean, you can research them. One America, Lafayette Life, Securities Mutual Life of New York, Guardian, and Penn Mutual. So those are the 5 today. Tomorrow, next year, it could be someone else, because we used to work with another company that someone here has a policy with, but they said, hey, we don't want you taking a policy loan. We're like, sorry, that ain't going to cut it. I can't keep dating you. So,
And then for anybody who's interested in a replay too, we'll have that out tonight. And then the replay gets edited down. So this kind of chit chat might not be on it, but it'll be on the YouTube channel on Sunday. But we'll have this, you know, unedited raw replay emailed out later today.
amazingness. Well, again, I'm so, what's the YouTube channel? So can you post Chris's and maybe even share mine?
Yes.
Awesome. Let's see.
Chris Naugle YouTube channel. If you don't know the YouTube channel, you're in for a fire hose type treatment.
100%. Like you're gonna see. Oh,
What obstacles?
oh, that's just me talking on my channel. Hold on, I'm pulling up mine here too. I'll share it with you guys.
So I just put in the chat, the YouTube at the Chris Naugle is like our main YouTube channel. There's a lot of infinite banking.
Please
videos.
subscribe to Chris's. There's 1 billion videos. You know, start with the one that interests you the most. Maybe watch how Chris lost $534,000. That'll explain some of the questions that you haven't asked and I haven't answered today, just because that hasn't came up. And how come I can't?
I've got yours. And then Jason's exact channel is the Wheel of Wealth, right? Well, there's the handle, I guess, but the Jason Sipple channel, I think I just put it in the chat.
I have to learn how to rename stuff. Make it
133 subscribers and 107 videos. Great job.
getting there, slowly but surely. Slowly but surely. All right, you all. Well, hey, Shauna, thank you for coming on and spending the time with me. Ivanka, we will get you that replay, and you can watch the edited version as well. And then we'll get, yes, C4, it is a massive rabbit hole. Have a good time. We all went down the same rabbit hole, and we're all here now. So have a blessed rest of your day. Until next Take Back Control Tuesday. We'll see you all later.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.